All right, the rains are coming down, and our thoughts are with those of you in the southeast, especially in North Carolina and South Carolina, and pray for the best for all of you that are affected by Hurricane Florence. The markets have seemingly been unaffected by hurricanes, trade wars, you name it. Continues to push a little bit higher. I'm going to break that down today, what we expect to see going into next week. I'm also going to break down a trade in the industrial sector area that will give us the best of both worlds, that will help us to profit if we get a breakout, but we can also make money on a pullback. So let's go ahead and get started. Today is Friday, September 14th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight, for tuning in. Welcome to those of you who are watching us for the first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel by mousing over this Market Scholars logo right here, and then click that red subscribe button that pops out. Also, click the thumbs up icon that's down below the video. That lets me know two things. You like the video tonight, and you want us to keep doing these videos. If you want us to keep doing these, the way you tell us is with that click. Very simple. You can do that right now. Comment on anything that stands out to you from the video. Join our daily Market Outlook email list. You see there's a link popping out in the top right corner of your screen. Click that link to subscribe. Follow me on Twitter for more content like this throughout the day, throughout the week. And join our Market Scholars community on Facebook. All right, let's take a look at the S&P 500 first with the market forecast indicator. We see that we have moved up into this range that we talked about before, this 29, 16, 50 range. You can see the intermediate line crossing back above 80, so back to a strong bullish posture. According to that particular indicator, the market sentiment's falling but still above 80, so it doesn't matter what it's doing. If it's above 80, you have a strong bullish trend. The near-term line has really entrenched itself up here in that upper reversal zone, so really strengthening the short-term sentiment. Again, I don't expect us to get to significantly higher highs. I'll show you here in a minute where we could get to. But, again, usually when the market doesn't do what I'm expecting to see, it's because we're more bullish than what I even think we are. And so we can definitely go up to new, stronger near-term highs. I don't expect it because of how long we stayed down, and the fact that we're nearing. At least I think we're nearing the end of this intermediate run, because we're now easily over 2 months. We're kind of getting close to 2.5 months now of this intermediate run since the intermediate line crossed up above 50. You can see, remember, market sentiment crossed above 50 right here in early June, so we're 3+ months into that now. And again, 1-2 market intermediate rallies. You expect at least 1 or 2 more before we get more of a pullback like this that we saw early this year that brought market sentiment back below 50. So we have a strong trend. We have strong short-term sentiment. A little bit of a drop in the momentum line because of the intraday drop, but bouncing off the lows kept it from finishing in the reversal zone, which actually kept it from having an intermediate confirmation signal. So pretty good signs for the bullish trend so far. You can see the Dow never did show a bearish posture. It's been a little bit more of an outperformer. It's still got a strong bullish posture. It does have an intermediate confirmation signal, which suggests that this near-term rally that we're on may last another day or two into next week before we get a near-term pullback. So again, it kind of probably depends upon any China headlines over the weekend, any fallout from the hurricane on the East Coast. Those kinds of things. If you take a look at the NASDAQ Composite, which has been underperforming, it's back to now having a bullish posture. It also has this intermediate confirmation signal today, and strong short-term sentiment. Not as strong because it's not as highly above 80, but still you got that. The intermediate confirmation signal would suggest that we could at least go up for a few more days, probably getting up to these old highs on the NASDAQ. The Russell 2000, which actually had more of a bullish day than anybody, that's what it needed to get back to its own bullish posture, so it's turned back up again. Short-term sentiment is not as strong. It was more bearish than what we saw in the others, this short-term pullback. simply because the previous near-term run was so bullish. So keep in mind, when you have really long, strong, bullish intermediate runs, then you're going to have pullbacks, right? That the normal pullback will simply be bigger. It will still be normal, but it will be bigger than other typical normal pullbacks because the intermediate run, the previous run was so large. So this one was bigger than what we saw in the other indexes, and so the near-term pullback was bigger too on a relative basis. But still only got to about the 38% Fibonacci retracement, so that's about as typical and normal of a pullback as you can get. It just seems worse because the previous rally was so long relative to the other rallies on the other major indexes. You can see a good bounce, relative bounce. We didn't close above any highs today, so it wasn't as bullish, and that's why you see the short-term sentiment's not as strong. So it's still got some room to go, and again, it's still got some room to get up to those old highs too. The ATR is 15 points, and we're about 20 plus points away from getting to those old highs. And again, the expectation is we can get up to new highs, just probably not very much higher from what we saw here at the end of August. Alright, before we look at some other charts, I wanted to remind you about our video on our blog. You can watch the market out if you're not already watching the market outlook video on our blog. Remember, there's 3 clicks we look for to see whether you want us to keep doing these videos, and they are to click right here, click on that heart, and then like tonight's market outlook tweet. Also click on the Facebook image here that pulls up this page where you can click on the like button there as well. You can also share it to your Facebook feed, your friend's timeline. You can click on this like button there. And remember, you can also participate by clicking on the link above the video. It takes you to a topic where you can reply to tonight's video to questions and topic or any questions you have, and keep that conversation going. You have to subscribe, so if you click this image, it takes you to this page where you can subscribe to our site, as you see here, for free, and that will allow you the ability to participate in our Market Outlook forum with literally hundreds of other market scholars who check this video, who watch this video day after day. Let's take a look at the long-term chart that we have going on. Here we go. And you see a nice good bounce today, or this week. We had a little bit of a decline last week and we bounced off. We still haven't got that red arrow. Usually we'll get those during the intermediate pullbacks that we haven't started quite yet. You're in this environment of strengthening long-term momentum. The last time we had real significant emerging market weakness was back here. And then that environment, which ultimately did result in the S&P showing some pretty strong weakness too, entering that period, the S&P was in this period of declining long-term momentum. So much different environment here. We still have the divergence setting up. It will take a miracle for a divergence not to set up. For this MACD to get above that peak, most likely is not going to happen. So at some point there will be a divergence. The low point right here in between those highs would be your target. That's going to be that will probably be another kind of market sentiment pullback that we'll get, eventually once we end this current one that we're on right now, if and when that ever happens. If that divergence doesn't mean that divergence doesn't have to play out, but if it did, that would be a significant drop down to 2600 again. Of course, like I said, I don't think that's happening anytime soon. If you take a look at the 3 green arrow chart, you can see we're not back to 3 arrows yet. The MACD is still not quite there. And if you look at it on a 3 line basis, you can see the MACD is just below its downward sloping moving average. So it hasn't crossed above it. Stochastics has. So there's still that potential that we get something like this happening again. This bounce that occurred. So that was a near-term peak that lasted a few days. We're kind of getting that right now. So that's our potential going forward. Looking at the intraday chart, you can see we did get another higher high and a higher low. We did close below last week's or yesterday's high, so not as bullish as we could be. But we are trading a lot closer to the 4-week high than we are the 4-week low point. You can see we came off of the midpoint after testing it and testing This is the Hakinyashi Open for this week, and so that's, we ended up getting a little bit of a lower shadow this week right there after having a little bit of a lower shadow last week. And so far that's not been a problem. We haven't reversed quite yet. This is what it looks like on the weekly chart. So you can see, it's still not, we're still not out of the woods, right? We're not getting a higher close. We did get a higher close than what we had last week on the Hakinyashi. Remember, the Hakinyashi close is an average of the actual open, high, low, and close for the week. So it's an average price of 4 different values. So that average price is higher. It still hasn't gotten above that high point yet. And that's when you're back to being bullish again on this particular chart. So still got smaller bodies, still have upper and lower shadows, still showing the potential for weakness on a long-term basis. And you look at next week's open, if you see, if I were to pull this up to SPY, and let's take a quick, let me get my calculator out here. If you take a look at, see, to the open and the close, 289.47 is the close. And then the open, and that's for the Hakinyashi close, not the actual, obviously the actual close is 290.88. The open was 287.94. Divide that by 2, 287.94. So that will put today or next week's open at 288.70. Let's go back to this chart here. So we'll change this purple line to 288.70. All right, so that's going to be the open for next week. So any movement below that purple line will produce another lower shadow for the index. Obviously, if you open next week below that, then barring an open below that, you'll also get an upper shadow. So we're still kind of in that mode. If we end up not trading below that at all, and we get a higher close than what we had this week on the Hakinyashi, then we're back to being bullish again. Again, I think it's going to be hard for us to maintain significant bullishness without an intermediate pullback, since we're already 2.5 months into this one, and we've got a 2 or 3 month period of seasonal bullish heading, coming up at the end of the year, and a lot of other factors are suggesting, potential for bullishness into the end of the year too. So, so with all that ahead of us, that's the timing, especially considering the seasonal weakness in September, would suggest that we'll get an intermediate pullback sooner rather than later. Let me pull up SPX. So in terms of how far up we can go on this next near-term rally, so here's the extensions. There's a previous near-term rally. Here's the pullback. So here's the current near-term run that we're on right now. Getting up to the old high would hit the 78% Fibonacci retracement. We're not quite through the Fibonacci retracement zone yet, so we'll look for some weakness now right here in this area. But otherwise, if we do break through to a new near-term high, look for it to peak right around 29.30. So again, where does that correlate on SPY? Well, that puts us at 293. So right in that area. And again, just for some context on what that looks like on the daily chart here, 293 is right about there, just underneath that blue line. That's not very much of a higher high at that point. So, that's where we could. That's probably, I would think that's where our ceiling is. I think right now the worst case scenario is the peak right here, considering that that's where we're at right now with that 68% Fibonacci retracement. I think this is worst case scenarios. We roll right over here, and best case scenarios we peak right around that 29.30 area. Let's take a quick look at the volatility, and you see here that we are grinding lower. So just like that, we're back to 12. And if you look at it on the relative basis, we're not oversold. We're not significantly oversold, but we are in the lower half of that bullish territory. So again, there's no reason there's no reason to be significantly bearish right now. The trend and volatility and even the trading ranges, when you look at today's trading range and the volume for SPY, You can see the volume at 53 million, the trading range today at 1.25 points. You put that in context, 1.25 points is way down here at the lower half of the range, below the average, still bringing it lower. And then the 53 million is also below the average and way at the bottom end of the 52-week range. So, it's the 100 million and the 3-point moves. Those are the bearish moves that we worry about, and we're just not getting those yet. So to summarize, we continue to show a strong bullish posture on the S&P 500. There's opportunity for some bullishness in the short term over the next few days that could get us up to slightly higher highs on the S&P. There is, potential that we can peak right now and roll over, especially considering any headlines that can come out over the weekend. But the reality is the trends and the market forecast suggest more bullishness early next week. With a ceiling just above the highs that we saw at the end of August. So what do you think about that? Do you agree with that? Do you disagree with that? There's the poll popping out in the top right corner. Click on that link up there and then click on either agree or disagree. And if you disagree, which is perfectly fine with me, scroll down to the bottom. Let me know what you're seeing. So show us a copy of a chart or a link to a chart, or describe what charts you're looking at that would tell us, or what indicators you're looking at that would tell us that maybe we should be a lot more bearish than what these charts are suggesting. All right, let's take a look now at what's driving the price action today, and you can see that we had retail sales come out today, continues to maintain. I mean, a little bit less of a year-over-year figure, but still relatively high compared to what we've seen before. In fact, the only other highest level that we've had was last month. So pretty strong numbers in that regard. You take a look at import and export prices, both pulling back, interestingly enough, considering the trade war banter that's out there. 1 month of import prices dropping, but 2 consecutive months of export prices dropping on a year-over-year basis. Again, a reflection of can be a reflection of lack of demand for these products, especially as anticipated higher prices are coming down the line. You take a look at all these indicators put together, you can see there's other things. The industrial production number was out. It was, it's the highest it's been on a year-over-year basis during this recovery. Excuse me. You look at the inventory data. You can see inventories up. So inventory growth higher, and then consumer sentiment. This is the initial consumer sentiment from the University of Michigan. It's only been above 100. This is now the third time during the recovery. So strong numbers across the board. I mean, it's helped out. The economic surprise index is still negative. It's not as negative, and the global economic surprise index is a little bit negative too. That's kind of kept, first of all, the GDP estimates also came out today with the industrial production and the inventory data, as well as personal consumption figures coming out. You can see back to 4.4%. So looking for a second consecutive strong quarter of economic growth. That's kept inflation expectations pretty strong. Here in September, you can see the numbers are down a little bit, still 80% odds of a rate hike in December, and of course March is the wild card because it's been a coin flip, and it's still a coin flip. It's still 50-50, down a little bit from yesterday, from a week ago, up just a few points. So it's pretty much a coin flip still that will get another rate hike, the first one in 2019, within the normal schedule that the Fed's been on. It's kind of what people have been watching to see. Is the Fed going to be done in December? Is 2019 going to be another year of restrictive policies, or are they going to start to taper off on that in case of an expected a slowdown that pretty much everybody's expecting, whether it's in 2019 or 2020? So when we take a look at the different asset classes and how they've performed, you can see small caps and mid caps had the best performance today, but so did the dollar. So a little bit of a mixture of risk on patterns here. On the other end of the spectrum, bonds and gold are two big losers along with commodities. So you know, pretty much a risk on days with a little bit of risk off, considering the dollar had such a good day. You can see high yield outperforming investment grade, EFA outperforming EEM, so EEM still showing some weakness. There's your bonds, this combination of bonds ETF with this foreign and U.S. stock combination, so stocks outperforming bonds on a broad sense. So that's, you know, it's an up day across the board. If you take a look at the major economies that are out there, let's take a look at the 12 grid for that. As usual, you can see the S&P kind of in the mix here. China struggled. Of course, a lot of the headlines today were involving China and trade, and that continues to push or put pressure on this ETF that's down, you know, 25% from its January peak. Italy is your biggest loser in Europe, and that's been a struggle for them over the past 3 months, and today included. India giving back some of its recent gains. On the other end of the spectrum, Brazil bouncing up, China or Japan and Russia. So kind of a broad mixture of strength. As some of these are coming up off their lows, while others, you know, still kind of languish. You know, Brazil had a good day, but still way down there. But pretty much across the board, you can see, I mean, green charts. So that means the intermediate line's rising. The intermediate line's below 50 on all of them. But weak bullish, at least they're bullish. And then you can see the S&P 500 maintains bullishness too. The only one that's not bullish continues to be Brazil because of how bearish it is. It's just so big. I mean, there's going to be some opportunity here at some point, but that value opportunity is just not right now. As we take a look at the sector performance today, financials have been so beaten up. It bounced. Finally had a good day today. Energy holding, you know, coming up too. It's been a weak performer. Remember, this is sorted in order of their sector selector rankings. Brandon will be updating those today or over the weekend. So look for that on our blog. But he, you know, that's in the midst of being updated. But on the other end, there's your weakness in real estate. Real estate had a weakness. VNQ was down today. Utilities down. So the weakness in bonds, the rising yields put pressure on these interest rate sensitive areas. You can also see some other stronger areas lately. Staples, discretionary, healthcare, all strong. You know, intermediate lines. You can see still maintaining some strength in industrials, but strong intermediate postures and just giving back some of that strength. So a little bit of a rotation away from technology discretionary, now moving into more areas like still healthcare and industrials. And like I said, keep an eye on, like I've said before, keep an eye on energy and materials, because if the dollar continues to weaken, it's, you know, it was up today, it had a good run today, but if it weakens, you see the red arrow here and the falling MACD, then those two sectors, energy and materials, will be your best bet. That's where you're going to find some opportunity. Update today is still a bearish posture, and, you know, momentum, the short-term sentiment doesn't suggest that we should be looking for an upward reversal to come out of this. It could, but, you know, again, one day more looking like something like this, where you had some weakness, one good day, and then more weakness. All right, so for today's trade idea, I want to take a look at an interesting pattern that's developing here on FedEx, which has been relatively overbought. Usually a pretty decent sign then when you get above the upper bands like this, especially with the bandwidth rolling up. But you are getting to the top end of a sideways range. I mean, we got higher than this back here, not with a whole lot of volume, and then before coming back down. So, you know, the orange lines here suggest that 70% of this year's volume is taking place in this range that we're at, and we happen to be at the top end of that range. So there's opportunity that we might hit some of this resistance and pull back. If we break through, there's not much resistance. We can go, depending upon news, anything that can impact and bring it back down, we could go all the way back up to these highs really easy, especially with the bandwidth expanding. But if we were to fall, you've got this node right here at 250-ish, close to 250. that will act as a strong support. That's where the most volume has occurred this year. And of course, another node right below that, closer to 240, that can also act as a support level. So you put those into the equation, say, okay, is there something I can do that will still make money, some money, if we do break out? But if we stay in this area where there's a lot of resistance and support, we can make some pretty decent money too, and so with a high probability. So again, what we'll do is we'll take a look at doing a long put vertical. So we will sell the 250 and buy the 255. That gives us $2. If we drop below 250, which remember, again, getting below 250, there's some strong support there. We'll make $3. We'll make the $5 difference minus the cost. Again, depending upon where you get filled in here, relatively higher spreads. It's a more expensive stock. But knowing that probably if we do drop, we won't go below that 250 area, or lower probabilities that we will, I can also sell another 250 contract. So what that does is it gives me, if I take a look at it on the Analyze tab, it gives me the opportunity that if we break out to the upside, I make $255. Worst case scenario and best case scenario. If we pull back, I can make all the way up to $780, and the amount of money it takes me to get in this trade will be about $4,700. So, you know, close to what, 20% gain, with a probability of making money at 94%. All right, because the only way the only way to lose money, according to this, let's analyze that again, is if we were to go down to 242. But remember, there's a strong layer of support here. There's that 242. There's a strong layer of support right there with that volume node and the biggest volume node, and then another volume node right about where that break-even level will be. So we've got lots of things that keep us from going down. Not that we can't. But we've got some support that will keep us from going down. We do have some long upper shadows that suggest we might see some short-term weakness. And if we do get some short-term weakness, we can get a decent gain out of it. And if we break out, we'll get a decent gain out of that too. We get about a 5. I mean, it happens to be about a 5%. Again, if you were to create a duplicate order, and so you're putting $4,700, so you'd be getting about 5%-ish gain. Again, very high probability. That's kind of our worst case, and that's kind of our second worst case scenario. First worst case scenario is really breaking down. The best case scenario is coming down into that established range and finishing anywhere in there where the 250 short put finishes worthless. Right, the 250 short put finishes worthless, and we make the $445 there. And the 250, 255 bear put spread finishes worthless, and I make the $300. That was the max gain on that. Again, as I go below 250, I start losing some money on the short put. As we finish above 250, I start losing some of that $300 on the put vertical. So that 250 ends up being kind of the sweet spot, and from a technical perspective, there's a sweet spot there too. So now I want to hear from you. Click the link in the top right corner that's popping out. That will take you to our Market Scholars forums, and let me know what you think about today's trade idea. Let me know what you think about the market posture and what our expectations are going forward. If you have any questions or comments on anything we covered today, if you have any questions or comments on anything I didn't cover today, make sure you post those in the Market Scholars forums like I showed you how to do previously. All right, that being said, thank you very much for watching tonight. I appreciate your time. Have a great weekend, everybody. Remember to subscribe to our YouTube channel. Click the thumbs up icon down below. Comment. Follow me on Twitter for more content like this. And join our community on MarketScholars.com as well as on Facebook. Again, have a great one. We'll see you next time.